Today, Bitcoin slips as low as $91,000 as investors eye inflation and Fed policy. An Oklahoma state senator proposes letting state employees take their paychecks in Bitcoin. And Seoyoung Kim of Santa Clara University lays out where U.S. crypto regulation currently stands and which regions around the world are getting digital assets policy right. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Crypto headed lower again this morning as concerns around inflation and interest rates weigh on risk assets. By noon Eastern, Bitcoin lost just 0.5%, but at one point traded as low as $91,700. Ether slid 0.33% to $3,300, and Solana fell nearly 1.5% to $191. Okay, let's talk about the top stories. An Oklahoma state senator just introduced a bill that would let state employees take their paychecks in Bitcoin. The Bitcoin Freedom Act was filed by Republican State Senator Dusty Deevers on Wednesday. Senator Deevers said Bitcoin has arrived into the mainstream of our economy and, quote, there is a reason President Trump campaigned heavily as a pro-Bitcoin candidate. He said Bitcoin provides an opportunity to protect earnings and investments for Oklahomans impacted by inflation. This move comes as other states introduce Bitcoin-friendly bills and amid talks around a potential Bitcoin stockpile at the federal level. Next, UAE-based property development firm DMAC entered a $1 billion deal with Mantra, a Layer 1 blockchain focused on tokenized real-world assets. Mantra says the collaboration would give investors access to a diverse range of assets in the group's portfolio and will be available early this year. Amira Sajwani, DMAC's managing director of sales and development, called the partnership a natural extension of the firm's commitment to innovation and said tokenizing its assets will provide investors with a secure, transparent, and convenient way to access a wide range of investment opportunities. This follows DMAC chair Hussein Sajwani joining President-elect Trump on Tuesday to announce the firm's $20 billion investment to build data centers around the U.S. Finally, the international banking group Standard Chartered is opening a new digital assets-focused entity in Luxembourg. The group says it'll focus on custody services to clients in the EU following the implementation of MiCA, the regulatory framework in the region that went into full effect late 2024. An announcement from the bank says Luxembourg has a, quote, well-balanced regulatory and financial environment to meet demand in the EU. Standard Chartered has made moves in the Web3 space in the past, including a recent launch of custody services in the UAE. All right, let's pivot to regulation here in the U.S. The industry has, of course, grown optimistic that the U.S. will pass crypto-friendly regulations as Republicans expand their control in Congress and President-elect Trump prepares to take office. But where do regulations stand right now? What's missing from U.S. policy, and are the bills that have been introduced in the past addressing the biggest issues facing digital assets? Crypto World's Jordan Smith spoke to Seoyoung Kim, an associate professor of finance at Santa Clara University's Levy School of Business, to find out.
Okay, so yeah, thank you so much for being here. I want to start with the sort of lay of the land for crypto regulation here in the United States. Where are we in real terms when it comes to regulation? You know, what are the gaps that you see? Because the industry argues that there are no regulations, while some in the government say that there are plenty of regulations. So I just want to know impartially, where are we right now?
It's a very broad question. So let me try to structure it a little bit in the way I'm looking at it. Actually, certain areas are underwatched, whereas certain areas are being overwatched in the sense that there are a lot of things that actually shouldn't be regulated in the way that they are just because they're crypto. If you look at non-crypto equivalents or things that are analogous off-chain, they're not receiving that treatment. But then there are certain things that are receiving more regulatory treatment when it's not on-chain, but the blockchain version of it isn't receiving that same treatment. So I'd say that it's unbalanced in that certain things are getting too much scrutiny and unfair scrutiny, and certain things are just kind of flying under the radar.
Well, I would love to know an example, because I think, you know, there's a lack of nuance when it comes to what's happening with regulation in crypto. And I would love to hear an example that you can give that, you know, maybe our audience isn't familiar with, that maybe is regulated, that doesn't align with what's happening in crypto, or vice versa.
Sure. So one thing is, early on, about 8 years ago, so many people were focusing on the Howey test for when something should be considered a security, but there wasn't much attention being paid to the Reeves test, which is when is a loan considered a security? So in common terms, if I lend you, Jordan, $10 and you're supposed to pay me $11 in a year, that is not considered a security. Reeves set a standard for when is a loan a security. And for example, if I give examples of things that are securities, if Microsoft borrows money from the public by issuing a bond, that is a security. When Coinbase tried to do their Coinbase lending program, where you can pledge your crypto to lend to other people who will pay interest. So you are trying to hold on to your crypto, but you're not using it right now, and you're going to lend it. Coinbase's lending program really did fall under Reeves in terms of what looks like a security under Reeves. And first, Coinbase said, just no, it's not a security. And the SEC said, yes, it is. And they withdrew it. Now, there are DeFi lending protocols that are doing exactly what Coinbase wanted to do in a non-DeFi fashion. And so that's what I mean by there's a disconnect between who you're looking at, and when there's other types of activity, maybe you're not aware of it, or maybe you don't understand the technology and the exact terms under which it's happening.
Knowing that there's so much nuance there, when you look to Washington and you look at some of the progress being made on crypto regulatory bills, whether that's a market structure bill or a stablecoin bill, which have both gotten a lot of attention, are the bills that you're seeing or the conversations you're observing from Washington properly addressing that nuance or the concerns in some of those contradictions that you're talking about?
I think the bigger problem is people who are making the regulations haven't really actually played around with the protocols or used them or understand the underlying protocols. So what I mean by that is early on, probably about 8 years ago, when people were trying to properly implement tokenized securities, there was a lot of pushback from legislators where they said, well, you're not doing proper KYC of the accounts because these are non-custodial accounts. And they also said, what is the recourse if someone steals a private key and then just transfers that security? Because with off-chain securities, we rely on the fact that you've been KYC'd and your brokerage firm is doing ongoing AML checks to make sure that everything is being done in a way that you're not promoting money laundering to institutions that are doing things that we don't want them to be doing. And all of that had to do with a misunderstanding of how these tokenized securities would be implemented, because you absolutely can whitelist accounts and make sure that the tokens are restricted so that you can't transfer it between those accounts. So it's sort of like the difference between if you just give me a bunch of dollar bills, you can't freeze my pocket. I can hand you dollar bills, and the best thing you can do is make it illegal to deal with me. But now when you put something into a custodial account, which is what we're most used to, we trust and put our money into a bank that's holding it as a custodian. Now they can freeze it so that if someone realizes that I'm engaged in something wrong, or if I end up on some OFAC list, then the bank can just freeze any access for me and for anyone else. But now there was this misconception that that can't be done with crypto. Whereas all of the things that are happening with smart contracts on chain, those are just software programs. These are if-then statements with data that's being stored. So that is a simple software program. So these are all things that you're able to automate off-chain, so you can program it on-chain as well.
I want to get to a final question. We've talked about the evolving U.S. regulatory landscape. I also want to know about the rest of the world. I mean, we saw MiCA go into full effect in Europe. There was a lot of advancement for crypto businesses in Dubai and across the Middle East. Which regions do you see as making the most advancement in terms of crypto regulation? And are there any areas that are maybe the most favorable in terms of striking that nuance that you were talking about at the beginning around the technology and versus some of the use cases?
Early on, Switzerland was one of the havens for this, and Zug was considered Crypto Valley. I think now the US has done a great job in terms of moving forward to make sure that things are being more thoughtfully considered, but there's still a big shortfall and a big gap. I think it is better to have more regulation in terms of thoughtfully considered regulation than in some of the areas that are letting things be freer, because then a lot of businesses or large financial institutions are afraid to build up an entire infrastructure where if there's not a lot of clear rules around it, then that might be ruled to be the wrong way to do things. And you've invested so much money doing it one particular way. And because right now, still in the US, there are a lot of rules coming out where things that were being done off-chain in our normal lives, now a lot of those rules are coming out to say, well, that rule is still going to apply in crypto, which makes sense. Whether you record it on a notepad or on Excel or on a blockchain, the same rules should apply to you for all of these different types of transactions. But there's still confusion as to what it means. And then that makes a lot of institutions worried as to how deeply should they try to build out an entire service and infrastructure when there's so much, there's not a lot of clarity. For example, even simple things, like there's been a long old rule about if you are going to, a lot of businesses don't want to allow you to buy something with too much cash. So you can walk into Walmart and even spend $500 and they'll be like, okay, that's a little bit different these days, but to have cash is not bad. But you can't walk into a dealership and buy a car and just put out a wad of cash. They can do it for you, but they won't want to. And the rule is with businesses, you have to fill out a form. Anything where with a business transaction, you've accepted more than $10,000 in cash, you have to report it to FinCEN and the IRS. And it's this like 2-page form and you have to like write all this stuff. And I don't really know that if you do too many of those things, if you get audited and people start talking to you and asking you more questions. But naturally then people said, well, if we're doing that with cash, we need to do that with crypto. So last year, this rule came out saying that same rule applies to crypto as well. But then everyone was like, wait, but what exactly do you mean? It wasn't specific enough. And so if you really think about it, you shouldn't just say any crypto transaction, because if you think about that rule, they're not talking about just cash in the sense that if you wrote them a check, or if you transferred the money from your bank, even though that's actual cash, it's already gotten into the banking system. What that rule is dealing with is cash that hasn't ever entered the banking system and has never been KYC'd and gone through AML processes. It's just a lot of cash that I never moved into a legitimate system that checked me. Because that legitimate system, if I suddenly had $50,000, I need to wait and slowly deposit it into my bank, or the bank is going to ask me questions and they'll fill out a suspicious activity report. So with crypto, it should be the same thing. We have non-custodial wallets that are the same thing as cash in your pocket. And then there are custodial wallets, like your wallet on Coinbase or Kraken or Gemini, where you've gone through that KYC. So even something so simple as that caused a lot of confusion, and people thought, well, what exactly do you mean by that? And then there wasn't a clear answer to it, when we should stop and think about what's analogous in off-chain land. And I think a lot of this comes from if you're trying to regulate something without having actually used it and knowing the technical underpinnings and the right analogous or the right analogies to make with the off-chain equivalent.
Okay, that's all for Crypto World today. We'll be back again tomorrow, and we'll see you then.